Hello, I'm Carolyn Herbert from the Finance News Network, and joining me from Canberra-based financial planners Shield Wealth to talk about using warrants to enhance returns in self-managed super is self-managed super fund specialist and senior financial planner Wayne Lear. Wayne, welcome.
Thank you, Caroline.
Now, Wayne, can you talk a bit about the difference between, say, using a margin loan and warrants and when you would use each of them?
Sure. A margin loan has recourse on the loan. So that means the lender can have recourse on other assets other than the actual shares, whereas a warrant is a non-recourse loan. So the only recourse the lender has is that specific stock and share. That's the main sort of big difference there from a security point of view. Hence the reason why warrants are extremely attractive to have inside of a self-managed superannuation fund, because of the non-recourse nature of the beast. The other big difference is that a margin loan is one loan over a number of shares. A warrant, or a bundle of warrants, it's an individual loan per security. In a margin loan, you can sell the share holus bolus to somebody and you still got the loan. Whereas in a warrant, when you sell the warrant, the loan goes with the share. So whoever's buying that warrant is also buying the loan. That's basically the fundamental difference between the two. The same principle of getting as much of somebody else's money, reducing the cost of that money below which you believe that wherever you invest that money, it's going to grow higher than the cost of that money. That fundamental principle always applies. And Australians are very used to that principle because we are wonderful proponents of negative gearing into property, which is what people do. They get as much as somebody else's money invested in property many times without any deposit, so it's 100% leveraged, and they can reduce the cost of that money from the rent and the tax benefits that they get. So Aussies are very familiar with that concept. However, not many of them are familiar with the concept of using that same principle in a much more safer way, mind you, in warrants. The big benefit of using a warrant, if you have a margin lending account, is that you can then transition the total exposure you have to the market across into your super fund. So what I mean by that is this. Let's just say you have a $400,000 portfolio on which you have a $200,000 margin loan account. Your exposure to the market is $400,000, your equity is $200,000. You would need to sell that entire amount in order to get that money into your super fund, which means that you're not transitioning $400,000 in, you're only transitioning $200,000 in, and therein lies the problem. You've now got exposure to only $200,000, where before you had $400,000. A warrant solves that problem.
So as you say, margin loans often do deliver attractive returns. Can warrants deliver that same attractive return?
Absolutely. The same. I have found in the past the interest rate on warrants invariably are cheaper than the interest rate on a margin loan because of the protection they put in that. So warrants are becoming the new margin lending, so to speak, and I think they're a hell of a lot more attractive than margin lending.
Well, we've talked about the benefits of warrants. What are the risks?
Well, the same risk with borrowing money is that, if the market goes down, then basically you can lose your money. It's the same with margin lending. They have margin calls. There are some warrants out there which you won't never get a margin call, but you'll never get your money back because they have what's known as stop losses. But like with anything, you need to understand the rules. When you go and drive a car, you want to understand the rules of the road so you don't have an accident. So it's the same with warrants. Once you understand the rules of the warrants and how they work, there are some very, very attractive and a lot safer ways of investing your money using warrants than there is margin lending.
And can you tell us a bit about what happened during the GFC?
We all lost our money during the GFC. Those that obviously, the thing about leveraging is that if you're leveraging dollar for dollar, which means that as the market goes up, you're doubling your money, and likewise as the market falls, you're losing twice as much. With those that had warrants during the GFC had no recourse, and those that had margin loans had recourse. So yes, everyone does lose money obviously when the market is volatile. I guess the next question leading on from that is, when is the best economic circumstance to invest in using borrowed funds to invest? And the answer to that is mathematical. And that is that when interest rates are very low, dividends are very high, and the market's been plateauing out or going along the bottom, that's a good time to be investing in warrants. And funnily enough, guess what we got today? We've got low interest rates, high dividends, and the market's on its knees. Now is a really good time to be buying warrants if you have the long-term view in mind.
So what are the key things you emphasise to clients with regards to these products?
There's a number of issues, number of things that planners, well, what I do at least. First of all, it's not for everybody. Right? This is definitely not for everybody. But those clients who have significant portfolios, $1 million or more, particularly in a self-managed super fund, where a third to 40 or maybe even 50% is in the growth asset side of the asset allocation, then it puts you above the rest in terms of maybe suggesting 5, 10 or even 15% of their allocation to Australian shares to consider putting it into warrants. This will help from a diversification point of view. I use a lot of ETF warrants. There's some very, very good ETF warrants out there with high yielding ETFs. High income ETFs like the WiMax Harvester from BetaShares, for example. And you can get ETFs just on financials, and there are warrants on those. So you might as well double up. If you believe that ETF or that asset sector in the market, like banks, are not going to go broke, why not have a warrant if you're there for the long term?
Wayne Leah, thanks for your insights into using warrants in self-managed super.
Thank you, Caroline.